20 years ago, technology primarily meant internet. Today, it means finance and healthcare and aerospace and security and enterprise SaaS and everything in between. These companies effectively shape many aspects of our daily lives, right? Even today, you went and you paid for coffee and that used a fintech company that's still private. And so with the fact that these companies are so mature, they impact every part of our lives, and they often have very grand missions. They want to go and advance humanity. Well, part of advancing humanity is letting the rest of humanity have ownership in some of that success. It's not just, we want everyone in the world to benefit from X innovation. But if we as Destiny can create a way for everyone to participate in owning a small piece of that success, then that benefits everyone.
You're listening to the Sandhill Markets podcast. I'm your host and Sandhill Markets CEO, Adam Hardy. Here at Sandhill, we focus on providing education, community, and access to venture. With this podcast, you'll get a seat at the table for discussions with other founders, investors, and innovators. I'm excited to learn a lot from these discussions, and I hope you are too. And you guys have known each other for, I don't want to force friends on you, but you guys have known each other for a while, correct?
So Hale's a celebrity, so it's hard not to know him, but...
No, we've been around the same space for a long time.
Have you guys never worked together? I thought for some reason that there was a overlap.
No, we're
not directly.
Not directly. Got it. Well, cool. Well, can I get Sim? Can we do intros? And I won't try to force one on my end, despite and Sim and I have known each other for a while. So Sohail and I are our new work friends. We'll say that. And but I'll let you guys do intros. Is that cool? On yourself personally, as well as Sim and Hiive, who we're big fans of, and obviously have been involved with for a while, and then Sohail and Destiny, which will be the kind of main topic of conversation. But yeah, Sim, you want to kick us off?
For sure. So we built Hiive. I've been in the brokerage space for shares of venture-backed companies for many years, and a couple years ago we launched Hiive with the idea to provide more of an automated, productized experience for participants in the secondary market, obviously buyers and sellers, but also the private companies themselves, right? Because while the market was screaming for centralization and automation, it also, the companies need a kind of a standardized way to administrate and manage all of their secondaries, right? From a company standpoint, they're not that concerned with a marketplace and how strong is the marketplace and all that kind of stuff. Some are, but what companies really care about is whether or not there's an orderly way to manage secondaries so that it doesn't become a full-time job for them. And so that's a big part of Hiive's mandate today, is to deliver that for private companies. And we've been live since May of 2022, and it's going really well. I mean, we've seen extremely rapid growth. I'm pretty transparent about a lot of our stuff online and social. And so yeah, you can check me out on LinkedIn if you want to see how we're doing, because I've shared a lot of numbers over there.
Yeah, no, it's been exciting to see it, and it's obviously we've been fans and participants in the market, but it's been great to see. There was definitely a shaky secondaries, right? Not so long ago, where it was are people going to start transacting? I think that time has passed, right? So people are definitely kind of at the table. So Hale, and with ultimately, you personally would love to hear your background a little bit more, and then, blurb on Destiny, and then ultimately we'll talk about Destiny a lot. So,
sure. So my background has always been startups and tech. Worked as an early engineer at startups, was briefly at Zynga, did my first company through YC, and then started what is now Forge, at the time called Equidate, back in January 2014. And so, that history is kind of intertwined with the history of the secondary markets, where there was this first wave around 2004, 2005 with Second Market in the Facebook era. And then there was this kind of second wave of secondaries, you can call it 2.0, around the time that we were founded, around 2013, 14, 15, primarily driven by Forge, but also you had, Shares Post and Equities and Zanbato and a number of other firms. And now we're sitting here a decade later looking at secondaries 3.0. And so a lot has changed. And at the same time, some stuff hasn't changed. And so in building Forge, eventually taking that public, one of the things that I realized, in conversation with my dad, actually, in conversation with friends, is most of the world, as we know it, our parents, family, friends, have never interacted in this ecosystem that the three of us are in. And the question that it kind of led me to is, why is there not a way for everyone to have this exposure and this access into this ecosystem? But also, what is the ideal way that would look? Because, as you've seen, and I'm sure we'll get into today, different kinds of structures, different platforms, different intermediaries. But at its core, how do you give people that access with liquidity, transparency, and what are the different ways to do it? And so that led to founding Destiny and our first product, the Destiny Tech100, meaning to be an exchange-listed fund that over time will hold 100 of what we believe are the top venture-backed companies.
Yeah, very cool. And so let's kind of continue in there on Destiny 100 really specifically, because you don't just launch a fund like that, right? It takes time. When did it launched in March, I think, correct? Like March of this year. When did you start putting it together, right? Like how long was it? How long were you kind of toiling underneath the surface, regulatory, right? Actually assembling some of the names before it went live?
Yeah. The company itself, Destiny, we started in January 2020. So coming on 4.5 years.
Wow.
It's one of those things people think that this is an overnight, it's very timely, but there's been years beneath the surface, like you mentioned, bringing this to market. But even, in terms of where this is today, it wouldn't be possible without all of the work that's gone into the ecosystem over the prior decade. So trying to bring this to market 10 years ago, there wouldn't be enough liquidity in the underlying companies, enough access and exposure to actually enable this product to be done well.
Got it. And so, and in terms of, so do you, and maybe to get a better sense of the setup, are you working like with platforms like Hiive on the buying and selling side? Like, are you ultimately like rebalancing? Like, give me let's go one layer down now within Destiny. Like, you have the names or like the total, you see the price, and ultimately like there's names within it that are like within the filings and stuff like that. But with any, fund like that, and I think that's part of the complication probably, is the need to rebalance within names, right? Some name goes up a bunch, then you have to drop it back down. Are you handling that all like yourselves, or is like, people like Sim and Hiive helping? Like how do you interact with the rest of the market?
Yeah, it's a great question. When we set it up and we created the Destiny Tech 100, one of the really important things for us was this idea of flexibility. Flexibility in our mandate to be able to effectively have flexibility in how we source available investments, how we structure investments, because our role is to get the best opportunities for the end investor. And you can only do that, and you can do that better when you have the maximum flexibility. What that means from a sourcing perspective is we participate in both primaries and secondaries. So we've done late stage rounds, series, C, D, E, F, G style rounds. We've done participated in secondaries directly with employees, management, tender offers. But we can also work with folks like Sim at Hiive, Forge, others in the marketplace and the ecosystem to participate through secondary channels. We can also work directly with VCs. And so our job is looking across everything that's going on in the market and actually trying to build this portfolio based on the best of what's available.
Got it. Yeah, that makes sense. And so I think Sim, maybe as someone outside of Destiny and looking at yourself, I'm sure that you've been in touch with a number of kind of different players in the market and maybe have a better sense of like the structure of like a Destiny versus other, like when you think about Destiny compared to maybe other offerings, can you educate us a little bit on what that space looks like? Because there's the publicly facing version, I think Arc comes to mind. But But then there's also like, plenty of privately held, let's call them, secondary focused funds that you would just never hear of that could be, reasonably large. Sim, can you kind of try to educate us a little bit about what that marketplace looks like and who are players there?
Yeah, totally. Well, I mean, I see that the whole Destiny story is sort of highlighting a really sort of interesting theme that's core to all of this in terms of the players and everything else, which is about access, right? Access to the private markets, the private investment asset class. And in particular, we're talking about venture right now. So in a marketplace like Hiive, because of sort of the regulatory framework in which buyers and sellers have to operate, and brokers like us, the main participants in a marketplace like Hiive are primarily institutional investors. And so while there are some ultra high net worth investors, some family offices, some angels, so there are individuals who are participating in the marketplace. And funds obviously like Destiny and others who are participating in the marketplace. The average retail investor is somebody who's like looking to invest, $5,000, $1,000, $2,000, whatever. They can't access the market through Hiive, and I think that's where the unique kind of what makes Destiny unique is that Destiny as a listed fund. Is from Hiive's standpoint is very similar to many other of the parties that transact on our platform. They're a fund, they're an institutional investor, but from their source of capital standpoint, they're very different from most of the funds we deal with, in that they are able to, through the public market, tap retail investors. Most of the investors that come to our platform have to jump through a whole bunch of different hoops in order to access our market. Accreditation requirements, suitability requirements. We need to establish a substantive relationship under regulatory requirements with buyers on our platform and all the like, which really limits access to the market to those players. And so I think that's kind of how Destiny sort of is very different from most of the other funds.
So one thing that we experienced really directly at Stonks and then Sandhill, and I'm interested to hear your take on it, Sohail, where we were super access driven. Like we were very much and started the down this path with hopes of opening up to unaccredited investors and into quote unquote retail. And the deeper we got, the more we saw the numbers not make a ton of sense in terms of it's like the 80-20 rule, right? Of like the 20% of people driving 80% of anything really. And it was even more to an extreme where we were seeing our bigger check writers move vast majority of the money compared to your smaller check writers, and ultimately it's the same amount of work, right? So for us as a constrained team, and ultimately like where we ended up going with it is we moved our check sizes up, we focused on some of our bigger relationships, because that's really where the business brought us. And I think that when you look at, private markets, I don't think anyone's like evil for not working with unaccredited investors. I think eventually you get pushed in that direction if you're doing a good job, that bigger check writers want to work with you, and you have the opportunity, should I spend my hour call today with a $10,000 check writer or $1 million check writer if they both have the same chance of closing? And it's just math, right? A business ends up pushing in that direction. That being said, there is and I think the private markets have looked at this for a long time, and a lot of software companies for a long time, like the long tail, right? Of but if you can automate or you can whatever, and I know Sim, I think that, with the product that Hiive is building, that's definitely a big part of it, right? Where big institutional brokerages maybe aren't going to give those smaller checks. And small checks in this space, can be $1 million for some people. Sometimes in some contexts, $1 million isn't a lot. When you think about Destiny, Sohail, in that sort of decision to go through a lot of shit to make it possible to raise, ultimately it was around a $50 million fund, I think was or at least the number that was quoted or something was about $53 million worth of stocks. I think or maybe raised closer to 100. That's actually not a massive fund in the context of secondary stuff. Why go through the trouble, Like, I guess, like, why, like, you're very experienced, been in the space for a long time through Forge. Like, why make it so hard on yourself?
Yeah, well, I'm glad you pointed it out. We did sign up to go through a lot of pain in this process, and it's not because it is, it would be quicker, easier, more financially beneficial to us if we just did this as a private fund, kind of the old way, and we could raise fund one, fund two, go out and do that. But it was really coming at it from a product first perspective and really what I wanted to see exist in the world. And that's really what kept us going through the last 4.5 years is, I know this is possible. It's possible in the current regulatory framework. There are precedents and history, but it's a huge pain to do. It's a huge pain to go through the process of being a reporting company, to do it in a world where if you're a private fund manager, you get, 2% annual management fee, 20% carry. And we're actually sitting here with 2.5% annual management fee and no carry. You're doing it for worse economics and you're taking on more overhead. But at the end of the day, this is just something where I felt like, it will happen and it would happen over time, maybe 5-10 years down the line, but we could actually, one, do it now, and actually drive the industry, not just secondaries, but really across the entire venture industry to have more transparency, more access, lower fees. And that's something that we're trying to do over time.
Yeah, no, and I have more kind of follow-ups on that, but Sim, I wanted to give you a chance too, because I think that maybe you both have visions there where you can make a lot of money just dealing with the big guys, right, Sim? And I think that you don't necessarily need, we dealt with this at Sandhill, where it's like a lot of our product kind of got overlooked. Or, if we're hand-holding a bigger check and the product's beautiful, you're kind of hand-holding the bigger check either way. So Sim, at Hiive, or do you think about it in it like, because you're still in the accredited space, but ultimately Hiive is built in order to allow for you to work down the, away from the 80, right? And towards, is it similar kind of thought process of just the pain now will pay off in the future?
Yeah, I mean, it's a really good question. So as a marketplace, our mandate is to maximize liquidity, right? So we need to show that there's sufficient frequency in the market. So we need to show volume, but we also need to show a frequency of trades. And so for that reason, and our market's transparent. So, we have the benefit of being transparent, which is attractive to people, but that's also a liability, because if you've got a security which has no trading, people are going to be like, well, there's nothing going on here. I'm moving on. I'll go trade this stock somewhere else where there is something going on. So transparency is both an asset and a liability. How do we maximize the frequency of trading? Well, clearly, you can go down the size range, as you mentioned, to fulfill that mandate, right? So we can deal with smaller transactions. And that's, I think, one differentiator between Hiive and some of the traditional institutional broker-dealers is that, including some of the banks and whatnot, that, we will deal with individual investors and buyers and sellers. But we do have a minimum, which we've implemented at 25,000. So individual investors who are accredited investors can come on the platform. But, there's reasons why, transacting in private stock is kind of more complex. There are, challenges associated with that for the average individual. There are a number of variables to consider. There's a lot of risk involved as well. And so I think that there certainly is a role for funds to come in who deal with the very retail end of the spectrum, right? So we're not dealing with the very retail end of the spectrum. Even accredited investors who are looking to invest less than 25,000 in a single check wouldn't come to Hiive because because we have that minimum. So that's how we've struck the balance. Is we've said, okay, we do want the smaller investors to come to our platform in order to help maximize liquidity and frequency of trading. But at the same time, we need to make sure that it's kind of there's an appropriate minimum transaction size threshold to ensure that there's a certain level of sophistication to be able to participate in this marketplace, which is otherwise like something that was more historically the domain of institutions.
There's a word that came up, I think, a few times of transparency, and I think that's a really interesting one in the context of private markets, right? Because it's like an oxymoron of a statement, right? Transparency in private markets, and I think that we've all dealt with this across our different platforms and products. How and Sohail most recently, right? And ultimately, what sparked this discussion was a New York Times article where I think that these two things were kind of clashing, like the idea of a publicly listed private stock index, right? Is like, again, you're like in that sentence, it's clashing. How do you think? And Sim, I think we all have opinions about this. What do you think of a company that wants to be private? Right, they're making a decision to be private, and then they're kind of being pushed to be more public. Right, ultimately, someone is buying their, at least part of their stock. What do you think? Like the role of you? Is it just pain that you're going to have to bear to order to like push the market forward? Do you fundamentally disagree with something there? Like where? Because again, there's a lot of tension. There's a lot of discussion to be had there, but like, how do you think about a company that says they don't want you to own their stock, right? What's your argument against it? And where does like the rubber meet the road in terms of what you can and can't do for those sorts of situations?
Yeah, well, to start off, one way to look at it is a tension between public and private. The way I look at it is actually it's an opportunity for Destiny to bridge the public and the private. And there are obviously benefits and disadvantages or challenges that come on either side. And our goal when we're thinking about it from all of the stakeholders involved, whether it's an individual investor, whether it's a market participant, whether it's a company, we want to bridge and bring the best of over time to everyone. And what does that mean? That means from the perspective, if you think about some of these companies, and all three of us have gone and probably spoken about and thought about the fact that companies are staying private longer and longer. They have more access to capital in the private markets than ever before. They have a much broader stockholder base of employees and investors and others than they might have had 2 decades ago. And so with all that, and the fact that these companies effectively shape many aspects of our daily lives, right? Even today, you went and you paid for coffee and that used a fintech company that's still private. And then you went and, did something else. And each part of our lives, 20 years ago, technology primarily meant internet. Today, it means finance and healthcare and aerospace and security and enterprise SaaS and everything in between. And so with the fact that these companies are so mature, they impact every part of our lives, and they often have very grand missions. They want to, go and advance humanity. Well, part of advancing humanity is letting the rest of humanity have ownership in some of that success. It's not just, we want everyone in the world to benefit from X innovation, but if we as Destiny can create a way for everyone to participate in owning a small piece of that success, then that benefits everyone. So from the company's perspective, we're not creating new reporting obligations for them. We're not saying, hey, you have to go deal with tens of thousands, hundreds of thousands, millions more stockholders. But at the same time, what we want to do is be able to provide that channel where suddenly these companies can engage with tens of thousands, hundreds of thousands, millions of individual investors, professional investors, and start sharing their story publicly. Not in the form of a quarterly earnings call, but maybe in the form of KPIs or how they see the future and fit, and vice versa for these individuals. I remember during my days at Forge talking to even some very sophisticated and wealthy family offices or other institutional investors. And even they, when we're sitting down, didn't know, should I buy Uber or Lyft? And if someone came to you and said, hey, this is back when both were private, obviously, and they said, I have an opportunity for you at a 20% discount to the last round. you don't actually necessarily know if that's a great deal or an okay deal or a bad deal. You need a lot more data and transparency, some of which you're starting to see on platforms where you're seeing, okay, where have transactions been closing? Where is the supply and demand? But even other information. And so it's not just that having wealth or being accredited means you're automatically an expert in private markets or in each of these industries. You need to understand, hey, what's a good deal? What's the structure? How is this going to work? And even for many people of means, that's not accessible. So Destiny, effectively, my hope is we'll be able to sit and bridge these public and private markets, give investors, again, lower cost, more transparent exposure into this ecosystem, and give companies and other participants the benefits of tapping into the public market demand without having to deal with the overhead that comes with that if that's not the stage they're at.
And to press there a little bit on the pricing aspect of it, because, and this is interestingly like out of your hands, and I think it's an interesting part of the public markets, and I think it is a big reason why a lot of private companies are dissuaded from going public, is that Destiny is trading significantly above NAV, I think, right? Like just from like the rough math of like the stock that they hold and what it trades on based off the data from places like Hiive and other platforms that provide data on that sort of thing. There's like this markup that happens just because more, it's once you set it free in public markets, quarterly earnings are cool if you're Microsoft and like it trades pretty tight and like the whole world covers you. But the whole like meme stock issue and Destiny like kind of went through that moment, right? Where it was like the price, as I'm sure you would admit, had nothing to do with the assets that were being held. And I mean, whatever it did from like a brand perspective, but not from like a net asset value perspective. How do you balance that? Because you aren't charging, you're charging less than normal fee, right? The 2.5 and no carry is less than market on something that could be 2 and 20, especially for smaller investors. But it's like a 3x markup on the net asset value. Is that like just what the market's willing to pay for the access? Or is that something that goes down over time? Like, how do you, like, it was, and I don't know what this was like internally and anything you're able to share, but I got it to be worth like $1 billion, right? I'm sure, I don't know what it's like at Destiny where you're like, I don't know if this is good. Like, if it was a tech company, you'd be like, we did it. Like, we're worth a ton of money. The public market loves us. But for a exchange traded fund, that's a little bit more worrisome, isn't it? Like, how do you balance the, the whims of the public market as something that's, you're built off of other assets, right, that are not public?
Yeah, I think it's really important to remember that we've been, since we listed, it's been about 2 months, maybe just over 2 months and 2 days. And so we're still very, very early on in our public journey. I think there's been a lot on any given day, someone goes and looks and they're like, what does this mean? And the answer is a lot of people are still figuring it out. We still have to build out our portfolio. A year ago, no one had ever heard of what Destiny is or what we're trying to do. And so it's very much when you keep that in mind that we're not at the steady state. This is just a moment in time. And so I think it's the market going through a discovery process. We're going through that discovery process very publicly. Again, people can see both where we've been, where we are, where we hope to go. And so that's something where I'm not too focused on the day-to-day there. I'm thinking about, 5 years down the line, where do we want Destiny to be? Where do we want the Destiny Tech 100 to be? Where do we want the ecosystem to be? And how does this fit in on that timescale?
And does that, and just from a structural perspective, does that money flow back into you guys? Like when it does it give you more cash to buy more stock when it goes up, or does it? I guess it wouldn't, right? It's just shares getting traded. Like when you guys sold some of it initially, like your IPO, you were selling shares, so you got cash infusion. So when it goes up,
when we listed, we actually listed as a direct listing, and when it trades, when a stock is trading on the NYSE on the day to day, it's all effectively secondary market trading. So it's holders that are buying and selling. We did in April file a shelf registration statement. which once effective would give us the ability from time to time to sell up to $1 billion worth of stock. And so that is distinct from the kind of intraday trading, but that is still subject to effectiveness.
Yeah. And so Sim, I think you're on, I don't want to say the total other side of it, right? But like in this idea of bridging where there's like, you can go on Hiive and see where something's traded, where it might be, bought or sold or something like that. How do you think about that, like that bridge and where best practice might end up being, right? Where it's like, there's definitely like Hiive, again, we're big fans and that's not a new statement, but like has gone and done its best to, reduce friction. It's still private markets, like compared to public markets where whatever, TD or Ameritrade account or like, or for a period of time, Robinhood, Sohail, which is maybe a different story, where it's like, okay, give me some shares. Actually, I'm out, right? Like within the same, bathroom break. Sim, at Hiive, obviously, it's, friction is down, but not all the way down. / do you anticipate it ever going all the way down? Or is there a part of the friction that you think is beneficial or appreciated on both the buyer or seller side? Like, talk us through that as you are, again, deeper into the private market side of things, but but product first.
Totally. Just going back to the question that you asked Sohail, Adam, just as for some context about, what is the, what do you say to people who object to sort of freer markets for private stock? And what do you say to these companies who don't want their securities to be traded? I would say I come at it from a slightly different perspective from Sohail, probably naturally because of our position in the ecosystem. But the first thing I think it's important to recognize is that nobody has a fundamental problem with liquidity, right? Everyone likes liquidity. Liquidity is a desirable thing in general for an investment to have, or a shareholding of something to have. I think where companies have reservations, management teams of these companies have reservations is primarily around a couple things. Number one is the idea that they might lose control over their shareholder base. And, private companies are used to the idea of this being something that they do control. Like, especially if you have a CEO of an earlier stage company, like when I say early stage, I mean early stage by Hiive standards, which would be a company that's, let's say, valued at $300 or $400 million in their latest funding. That CEO, when they get confronted with the idea of a transfer request, might bristle at that the first time they hear about it, or the first time they hear about brokers making a market for their stock or marketplaces. A lot of them don't even realize such a thing exists, and if they do, they're kind of like, well, who are you to be facilitating trades in my stock? This is my stock. So I think there's some element of that feeling of like a loss of control that some of these companies, that when they reach a critical mass where there is a good backdrop for trading, or some backdrop for trading, i.e. there's enough shareholders, the company's well enough known in the market that there's like the opportunity for a market to exist or to come about, they have a knee-jerk negative reaction to this feeling of a loss of control. And I think that the other big barrier for companies is the fear of follow-on, knock-on effects, primarily from like a legal and or regulatory standpoint, right? By allowing freer trading for our stock, what kind of legal problems are we potentially running into? Are we going to end up with too many shareholders? Are we going to accidentally conduct a tender offer? Are we going to impact our 409A valuations? So from my standpoint, neither of those two things are a fundamental barrier to freer trading in the private market. I think that the way we're going about approaching that is to say that, look, we can set up a market for a company's stock and still give the company control over important parameters like who's buying the stock, who's eligible to sell, when are they eligible to sell, Does there need to be some kind of price floor just to be cognizant of certain sensitive topics? And then I think the rest of it is around education, right? Is to say that, look, we are doing things in a controlled manner that sticks with regulatory requirements. For example, we know how to run things such that you're not going to accidentally be accused of having conducted a tender offer by mistake, or you are whatever, allowing too free trading, or the wrong people are trading. So part of productizing this is to be able to put those protections in place so that companies don't sort of have to worry about that uncertainty of how are we impacting ourselves and our shareholders from a legal standpoint, by having a freer market. Now, I think what's probably a tougher sell from a company standpoint, because I think companies want to be able to, there's a value proposition for them in having a relatively liquid market, providing you can allay those concerns around control, regulatory concerns, and so on, in having a more liquid market for the stock, because a lot of them don't want to go public, right? And so I think that if you told them, look, you can have a pretty free market for your stock with virtually no consequences, then I think that a lot of them would be more in favor of freer trading. I think I think the argument to be made to private companies is a little bit tougher to make when you start talking about things like democratization and all that kind of stuff, right? I mean, I think it's attractive and interesting for small retail investors to get access to this asset class, but there are important sort of reasons why they don't have direct access to the asset class. And one of those is the fact that you don't get information on these companies, right? So these private companies do not publish financial information on themselves. They're not required to because they're private. And that's one of the big benefits for being private, right? So if we're saying that companies are private for a reason, well, that's one of the reasons, right? The massive administrative burden of being a public company, and the fact that you have to, for lack of a better term, drop your pants, share your information with the whole world about what you're doing, right? And possibly your competitors as well. I think so long as that becomes a key, remains a key reason for being private, that friction is always going to exist, and that barrier to direct access into the private market has to exist, because you just can't have everyday people who are investing very small amounts and who may be unsophisticated, sort of taking stakes directly in these companies. So I think that's kind of where we in our role in the ecosystem have to draw the line. I mean, that's just by law, but I think there is some reason for that.
Yeah. And so, Sohail, when you think about, kind of the stuff that Sim just touched on and about democratization, or like words like democratization, do you agree? What do you think about, because you mentioned earlier, right, the ability for people to invest in, companies that are building the future. The hard part in that is that it's like, somebody owns it, right? It's their private property, and they might want to share the future, or they might not really. And it's up to them if they want to. Where do you land on it? Where do you push back on it, if at all?
Yeah. When I think about it, again, you can't speak out of both ends of your mouth. So if you're a company and you say, we want to do X in the world, right? A lot of these, especially the later stage companies, have very grand visions and missions about benefiting the world and humanity. You can't say you want to benefit the world and humanity and then go and say, oh yeah, but we don't want anyone but our friends to make money from it. We don't want anyone else to participate in that growth and success. That's kind of speaking out of both ends of your mouth. And so you have to decide, are you doing something for the benefit of humanity or not? And if you are, and somebody presents you a way to be able to have the rest of the world participate without creating new reporting obligations or new burdens, then you should welcome that with open arms. And so philosophically, I think, if somebody steps back, I totally understand why a company wants to maintain that control. And that's exactly why, we're very proud of the Destiny structure, where you're not introducing tens, hundreds, thousands of new direct holders on the cap table. For an individual investor, you're not just investing in a single security or a single underlying security. It's instead a basket and a portfolio. And what that means is, sure, you may not, you have varying levels of information, maybe of what a company is publicly reported, but you know that it's not just any one company that you're getting exposure to. It's a number. And so I actually think that this is the way things should work. Like Sim said, for regulatory reasons and otherwise, it's not going to be possible for everybody to be able to invest in any single company with no information. That doesn't align. But creating portfolios whereby people can express their views on the private market, but with the liquidity and protections of the public market, for me, that seems to be the answer for all the parties involved. So I know I'm biased in saying that, but I also think that's like to my core that is the answer for the ecosystem.
Have you had that? So when you have that conversation with management, how do they respond to? Because I think that the thing that I could very easily go on the other side of the table as a founder, and I think that you can separate. In my mind, I think I can separate building a solution for the future and who owns stock. Like I don't necessarily think that if I'm building whatever, some big company that, is changing the future of rocket flight, let's say, that I necessarily think that I owe people my cap table because of what I believe in the humanity aspect of it. But so are you making that pitch? Like, do you find yourself making that pitch to management? Or is that just more kind of internally how you think it will play out eventually? Like, I don't know, where does that come up? Like, do you find yourself, and obviously and we'll get into the marketing aspect of all this, which I think is almost a separate conversation, not about the things you're saying, but like the game that gets played there. How does management react to something like that? And Sim, I think I'll be interested to hear how they react to your kind of, because I think yours is softer, right? It's like we're each like I basically operate completely privately now. We used to be like do some pretty loud stuff. Now it's all behind closed doors. Sim, semi-open platform, accredited investors, like, but more transparent than my closed syndicate. And Sohail, all the way on the other end of the spectrum, where it's like you're again like it's retail and it's access driven. How does management react to that?
I think, yes, similarly for all three of us, it always is on a company by company basis. Depending on the experience of the founders, their personal perspectives. Some people, like Sim mentioned, have never even thought about it until it suddenly comes up that somebody wants to buy or somebody wants to sell. Others may be experienced founders, have seen this ecosystem. They may have invested in other secondaries or primaries of other companies. And so depending on each individual, I'll say founder, management team, board, they have varying levels of experience in dealing with this and varying perspectives. And so, since we've listed, I've heard from another number of late stage unicorn founders and others saying, hey, we would love to learn more about Destiny. How do you work with companies? How can we be a part of this? What do you need from us to consider us being a part of this? And so I view a lot of where we are as Destiny. I think it aligns with what you guys are doing as well. There's a lot of education to be done to each stage, to each part of the market. Education to individuals, education to companies, education to other market participants. And I think that's still where we are. As people are discovering this, they want to understand more. They want to understand, hey, from a company perspective, what are the implications for me, whether that's legal or regulatory, or in terms of control. From an individual investor, okay, what is this product? How is it structured? What does it mean for it to be a listed closed-end fund? And from each participant, it's really, again, having them understand more, because this is something that each of the three of us in our own way think about every single day, but other people don't have the benefit of that, and so it's part of that education process.
Yeah. Sim, where's your conversations with management nowadays? Sounds like it's been good. Sounds like it's been positive.
Yeah, I mean, look, it is quite varied. I mean, Sohail is absolutely right that it is dependent on the individual management team. I think that some of the more progressive management teams have viewed the secondary market as like, look, it tells a story about our stock. Whether the price trend, I mean, look, these days, obviously, we're in a bit of a downturn for the venture world, AI aside. And, you do see stocks trending flat in price, trending down in price. A lot of stocks trended negatively in price, but that's just a overall market trend. And I think that a lot of CEOs now are taking some measure of pride in the degree of liquidity that they have in their stock, because it demonstrates not only that they've got an institutional following for their stock, like there are investors who are interested in their stock, but that there is an available market for the stock, right? I mean, I guess two sides of the same coin, but we're popular and we have a way to outlet. We've got a way to tap the market for capital, whether that's primary or secondary capital. Incidentally, I mean, that's a really key theme that we think is going to be evolving over time, which is that founders are going to increasingly see the sort of the market, right? Forget the secondary market, just the market, right? In general, writ large, as a place to tap as a source of capital. And, right now we've got all these really traditional structures in place, big banks and other sort of very traditional structural elements in place around private capital flows that I think are going to be coming down over time. And so I think if there's one place where certainly our mandate and Sohail's mandate are pretty aligned, it's in this idea that we're modernizing the way in which capital flows from some really, it's funny, financial services is a place where there is so much money, and some of the richest people are rich, greatest fortunes are built in this industry, and yet there has been such a entrenched kind of way of doing things for so many decades, and a resistance to kind of disruption and modernization. And so I think that's a trend you're going to see. And like I said before, I think as long as you can, there's an education process. There's a process of educating founders around the value of a liquid stock. A lot of these founders are tech founders, right? They're developers, they're technologists of varying kinds. They're not familiar with the concept of liquidity. What does that mean? What's the value of that? Is there value creation like in having a liquid stock? So there's a significant amount of education that has to go on there. One other comment I'll make is that one of the things that we hear about companies that are restrictive is that they feel that if they allow their employees to sell more freely, that they will reduce the retention value of the stock options. And I guess I definitely disagree with that. I wouldn't say I'm like an absolutist in the sense that I think you need to allow employees to sell all of their stock, but the argument that I make is that if you have something, and this is the argument I'm making to founders all the time, publicly and privately, is that if you are an employee and you own stock options or you own an asset like that you're not allowed to sell, well, is it really worth anything to you at all? And I've spoken to the GCs, literally the GC of a big company who is in charge of enforcing their policy around restriction, and he tells me, my wife tells me not to even mention my stock options to her. She says, that is worthless. I do not want to hear about it. This is the guy who's the bad guy who's telling everyone else they can't sell their stock. Yeah. And he's suffering from the same pain, right? So my view on that front, and I think that's one of the things where a lot of companies and their boards say, oh yeah, don't let them trade because you're gonna once they can sell, they're just gonna go somewhere else. Well, the reality is that if they feel that they're going to be private forever, the company's going to be private forever, and they're not going to have the option to sell, well then you've lost the retention value. In fact it's the opposite. It's worthless, and it just gives them a reason to walk. So I think striking a middle balance, which would be to allow them to sell a certain amount every year and generate effectively a stream of regular income from those options, and do what they were intended to do in the first place, right? Which was act as a form of compensation, right? I mean, the whole idea behind stock options is that you get them on day one, they take 4 years to vest, you put your time in, you earn those options. Once they're vested, well, that's your property, right? I mean, you own that stock, and you should be entitled to dispose of it. Maybe companies don't open the floodgates and just let them sell 100% of their stock the moment it's fully vested, but I think there is a middle ground, and a lot of companies are starting to strike that balance and saying, well, actually, the retention value is optimized when you do allow them to sell a certain amount of the vested stock every year.
I'm excited to go deeper into this, like what we think. I had this actually question written down before of like the idea of best practices. I think it's something that's really rapidly evolving in private markets because of this like shift that we went through over the course of the last decade of like, you know, going private or going to public after 6 years or going public after 12 years. If not, like you look at some of the biggest name in private markets, it's like, why would they? What is the actual point? And I think that it's so interesting that you mentioned like the GC in that situation where part of why I'm so, you know, it's part of why I've hung out in this space and made a decision to like build in this space and work in it is because I do think it's rapidly developing, and because that new best practice of like it being used and as like a employee, like I think if you don't have a real plan for liquidity, you won't get as good of talent as you would if you did. And I don't think that that's happened yet, actually. That's like in the course of happening, like over the course of the next 2 years, I think we'll see CEOs pitching employees like really, you know, sought after talent of this is what your options look like, and this is how we handle liquidity, or this is like my commitment to handle liquidity 4 years from now. Not today, not day one, but like 4 years in, if we're doing the things that we want to do, we'll have it. The thing that I want to mention more on the pessimistic side, we can talk about the more, you know, the positives and, you know, hopefully the future we all want to be a part of. There's also that kind of uglier idea of big holders keeping pent up demand, where the idea of like, if you release too much steam from the like, everyone wants to buy stock of, you know, whatever company, and the big holders are like, okay, should I let that steam, should I let the pressure out with the employee pool, or should I keep that for the next markup? You know, institutional buyers are going to like publicly pump this up, or my own ability to sell a larger block. Have seen, you know, I've never actually interacted with it directly, but I've definitely been around companies before where it's like, this seems maybe like you're serving, which again, you know, everyone's like serves somebody to a certain degree, right? They're like, you know, looking after LP money. But ultimately, I think that employee kind of drum needs to get beat more. And I think maybe that's something we're all a part of. But certainly back on the best practices. So I think, you know, Sohail, to you, do you get asked about best practices? What do you think best practices are? Ultimately, you're building Destiny with a vision of what the future of private markets will be like and how you'll be a part of it. Do you think companies will go public again? Do you think, you know, Destiny they won't, and that Destiny will be like a big access point for retail? I think maybe leans in that direction. Yeah, tell me a little bit about your vision of like, you know, best practices in private markets, both and from the management side, right? Where if you were knowing what you know about the secondary marketplace and knowing what you know, what you think is like, oh, I would tell my friend who runs $1 billion private company that this is what he should be doing, or she.
I think it goes back to bridging the public and private markets. And what I mean by that is it doesn't have to be such a binary point in time. There's absolutely no liquidity, and then you're listed and there is liquidity. And so that's from the liquidity perspective. Even from the education perspective, I think what ends up happening over time is it becomes more of a continuum. Ideally, you know, I hope that we as Destiny, you guys in the ecosystem, all serve to help bridge that continuum and gap where as a company goes through various stages of maturity in its life cycle, it adds those things. A company improves its internal controls and financial controls as it grows and matures versus when there are 5 people in a living room and there are 50 people and there are 500 people. Similarly, same things, ought to happen as it relates to transparency, as it relates to liquidity, things like that. And I hope that, there's a lot of infrastructure that we and you guys and others can build to make that process easier. I think we've also seen this happen naturally. You saw companies like Uber and Spotify actually start publishing, their quarterly financials voluntarily in the years listing up, in the years as they're getting closer to their listing. And so you've seen this happen where companies start improving their own internal controls, their own compliance functions. Hey, we need to be able to go and behave like a more mature company, be able to report in a timely manner, be able to do that. And so same thing with liquidity. I totally believe in companies being able to optimize their structure for their goals. But they can do so in a way that, can ultimately enable this for employees. So whether that is through regular tender offers, whether it's through kind of interval liquidity programs, whether it's by partnering with marketplaces and enabling more of a constant flow of liquidity, but with the guidelines that they set, I think it's about bridging that private to public and kind of each side of it. Suddenly, you don't have, it's not just about creating a kind of pent up steam where companies waiting until it goes public. And actually, when you think about what has happened in the ecosystem in the industry, everyone has always tried to go one step ahead. So you think about in 2020, 2021, the SPAC craze. Why were people investing in these SPACs where you gave some guy a massive promote because he was well-known, he or she was well-known and did deals? Because they said, okay, well, I can't participate in IPOs. Maybe if I participate in the SPAC, this person's going to help me go and cut the line by one step. And so everyone's always been trying to kind of go one step further. And so the hope is that this actually becomes more of a continuum rather than a stepwise function.
Yeah. Sim, yeah, I think that we talked about it a little bit, but yeah, do you think about it in that continuum way? Where do you think about kind of best practices and what you think the future of doing this the right way would look like?
So I don't think you'll ever see the degree of liquidity in private markets as you will in public markets. That's clear. But I think Sohail's idea of sort of this vision of bridging the private and the public market through more active private market trading is a very powerful idea. I think that is precisely kind of what I'm imagining the future to be, which is, if you look at, I actually recently did a post on LinkedIn about Rubrik where I was kind of analyzing how the stock behaved in the year or so prior to when it went public. And it was known in the market that there was a plan to go public, that it was going to happen soon. A lot of these companies, it kind of becomes known in the private market about it as much as a year beforehand that there's a very high prospect that the business is sort of at a place where it's got a high potential to go public. And during that time, if the company allows freer trading, what you see is you see the price of the stock rise. So what you see is trades happen, and you see the price of the stock rise. And so what's like, I guess the simplest way to look at that is like, okay, people trying to get in ahead of the IPO and trying to get in cheaper than the IPO. But what really is going on there? Why are you going from a lower price to a higher price between private and public? Well, it's about liquidity, right? It's the infusion of liquidity into the stock is what causes its price to rise. And so I think that companies increasingly are going to be thinking about that in terms of, for a number of reasons. Number one, to demonstrate and establish like an institutional following for the stock even before they go public. The other thing is to, not leave as much money on the table when they do go public, right? I mean, if you didn't allow trading, well, then you were effectively artificially suppressing the value of your stock. And then once the liquidity pours in like a tidal wave when it goes public,
the IPO pop.
yeah, exactly.
Yeah,
Then the price goes crazy, and you saw during the boom times, you saw like 100% markups and between pre and post IPO, and so I think that is something that doesn't make sense for really anybody to have such a massive gap, and I think that bridging thing is the way to solve it. One other comment I'll just quickly make about the question of making sure that you sort of create pent-up demand. I think that's it's very interesting because that is something that we hear. You hear that's another one of those objections from companies, which is that, and it's really driven by the board, right? Because the board consists of some very sophisticated venture investors and funds, whereas management, like I mentioned, often consists of folks who are less sophisticated from a financial standpoint, right? Financial markets investment standpoint, because these are founders who know a specific domain, they may be technical folks, and so on. And so they aren't necessarily as financially sophisticated. And I think what these founders often get sold by their boards is this idea that if you allow secondaries now, if you allow trading in the stock, you're cannibalizing primary demand. I think that is a very faulty and actually self-serving message that boards are sending to their investors and to their management teams. And I actually think it's the reverse. It's not about suppressing demand from these board members' perspective. It's about suppressing supply. And by preventing people from selling their stock, what you're doing is you are controlling the supply of that stock as a board member. And what are your interests in that? You've got a number of interests. If you talk about, for example, SpaceX stock, and I'm going to give you some like red meat, as Jay Cal would say on the All In pod. If you talk about SpaceX stock, the board and management of SpaceX have severely constrained the supply of SpaceX direct shares into the market. And what they've done is they've allowed a club of large investors, large funds, to hold the stock directly. And then what happens is there is a very active indirect market for that stock, in the form of SPVs that trade in a range of places. But the effect on the market of that is very simple. These direct investors, the ones who have access directly to the stock, buy at one price. The rest of the market buys at a different price. The rest of the market buys at a substantial premium to what the direct shareholders, who are typically board members and other funds who are very close to management, are paying. And who is capturing that arbitrage? Who is capturing that gain? Well, it's those funds and board members who are capturing that gain, right? So liquidity, we're not going to have enough demand for the shares if we allow free trading. Is a mistruth. That's a manipulation to state something like that, because anyone who's sophisticated in financial markets, like these board members and people who are active in financial markets as investors, knows that liquidity begets liquidity. In other words, when something is liquid, it will attract more investment rather than less. And that is precisely what's going on with Destiny, right? The fact that something has become liquid has allowed it to attract a lot of investment. And the same analogy exists in the direct private market. When you allow stocks to start trading more actively, what you will do is you will attract more investment to those stocks, because now there's an established market price, and investors know the stock is liquid and therefore less risky, and so on.
Yeah, no, it's interesting to bring up that example, because and obviously, SpaceX in some ways operates in a league of its own, but I think the things that you're saying are true. I'll take and we'll wrap up here in a second, but to take the flip side of it, though, and to take a very optimistic view of the SpaceX board and what they're doing, they have had you look at that chart, and it's a good company to work at, right? Because you get liquidity twice a year. You get liquidity, and it's probably going to pop up by anywhere from 5 to 15% twice a year, and that's probably less than it could, right? Less than it, whatever. It's less movement than what we would see, but it's tight though. It's like something you can, you talk about the employee perspective of what to expect in your comp. What are these shares worth? And I think that I totally agree with what you're saying in terms of like, there's definitely insiders within that system that have built careers off of like running SpaceX SPVs. Is that right or wrong? But in terms of when I think about best practices, I do also find myself thinking about the Elon companies oftentimes that run on these regular schedules where it's gonna and if you're working at that sort of company is so much different than working at, we've all seen multi-billion-dollar companies over the course of the last few years go, from being worth a few $billion. I have friends that thought they had a ton of money in options. Market takes a turn. They miss the IPO window. They don't have any money actually, and they had no and you've got employees scrambling for like, holy shit, how do I make this number mean something to me? So but I agree. I think that it's ultimately like the control and again a very optimistic view of how that plays out, and there's definitely examples of it being less clear or being more openly or blatantly like, well, no, we're just going to make a lot of money off of this. Well, guys, I think that, we're 5 minutes over. Are there any closing remarks? Sohail, I know that it's, I think I came in after having read the article. I read the New York Times article, and we had never met before, and I'd seen the price jump and all that stuff, and I was like, what is going on with this thing? But I definitely, for the amount of pain that you had to go through to get it public in the first place, there's a lot of ways. There's easier ways to make money in the secondaries market. So any sort of like, I think that the word scam has gotten brought around. Like there's companies, right, that are like, oh, we don't like that, bring that sort of thing up. I definitely am not someone who would ever, especially after having talked to you, who would think of it as that. Do you have anything to say in terms of the future of Destiny, what things that you're excited about, over the course of the next year or in the future to wrap things up with?
Yeah, well, as a regulated, publicly listed fund, there is only so much I can say. But, from my perspective, again, it's very easy to look at this and, people have said, oh, this is a point in time. Oh, it's a market. But, I've been working on this space and this ecosystem from Forge to Destiny for the last decade. Destiny has taken 4.5 years to get to where it is today. And I think there is a lot of change happening. My optimistic view is a lot of venture has gotten very comfortable taking 2 and 20. And they sell it as, oh, I'm very smart. And some people are, and those people are incredibly talented investors. But many others effectively sell access. And they sell access for 2 and 20. And so this is very scary, this being Destiny and Destiny existing and what it could mean for the future of the ecosystem is very scary to a lot of people, because suddenly it means that you might not be able to sell access for 2 and 20. And so, it becomes easier to go look at a point in time and say, oh, well, this isn't a perfect structure. Oh, there are other things that could have been done. But when you think about what we're trying to do in the market and in the ecosystem and the steps we've had to take and the steps we're taking to get towards that vision and that reality, I think there's, the best is yet to come.
Yeah. Well, exciting. Thank you for listening to the Sandhill Markets podcast. If you enjoyed this discussion, make sure to click the link in the description to subscribe to our newsletter. You'll be kept up to date on venture news and our weekly live events where we host similar discussions with other amazing guests. You can also follow us on LinkedIn and Twitter, where we post regularly about upcoming events. Once again, thank you for listening, and talk soon.